Thank you for joining us tonight. We are June 27th, 2023. It's 7 p.m. Eastern. And tonight, my partner Jeff and I were going to talk about investing beyond traditional rental properties and REITs. So we wanted to welcome everyone to this presentation. So just my name is Philippe Scholligan. I'm the co-founder of Boost Capital Group. Again, welcome to our live webinar about alternative real estate assets, investing beyond traditional rental properties and REITs. Just for a little bit of housekeeping, this webinar is being recorded. And we will hold a live Q&A session at the end of the webinar. So you may have a question feature available as an attendee or potentially a chat, but you use one of those if you want to ask us any question. We'll address all the questions at the end of the webinar. Short disclaimer, we do not provide tax or legal advice, and the material herein is provided for informational and educational purposes only. It should not be construed as investment advice or an offer or solicitation to buy or sell securities. So, we are your hosts, Jeff Rodriguez, my partner, and I, Philippe Scholligan. And we formed Boost Capital Group because we share a common vision and values. Our vision is that we believe that everyone deserves to spend time with their family while building a bright financial future. And in order to do that, we offer alternative investment opportunities in real estate to busy professionals and family providers. Together, we have more than a decade of experience in real estate, and we've helped people invest in 2,800 multifamily units with an average to date of 30% annual returns on full cycle deals. Jeff?
All right. So today we're going to be going over pretty much the funds and real estate funds. I mean, there's the specifics, unlocking the benefits, why invest in a real estate fund, investment options to explore and analyze the risk and rewards of real estate plans. Next slide. So we're going to get right into what is a fund, and pretty much is a basic definition of a fund. It's an investment vehicle where investors pull their capital together in order to invest in different types of securities. So securities that you would see common in a fund could be a mutual fund, REIT, or something like that. Would be stocks, bonds, commodities such as gold, oil, silver, corn, things of that nature, real estate, and newest one, crypto. And you shoot over to the rights, we go more in depth of a real estate fund. Same thing, same concept, but it's tailored specific to real estate assets. And the type of real estate that you would find in that can be a residential real estate fund. It can be focused on land development, and it could be focused on commercial real estate, which includes the office spaces, industrial use such as Amazon warehouses, data centers, multifamily apartment complexes, which we are heavily invested in, retail, mixed use. So anything that's commercial that's not residential, such as single family home, condo, or something like that, or land. Next slide.
All right, so unlocking the benefits, right? Why invest in a real estate fund? So we can see here, we listed, the top benefits of investing in a fund. Number one is the recession resistance, because, there are properties, real estate properties, values have continuously increased through time, and particularly through the five previous recessions. During three of those, values continued to increase. So, historically, as long as you pick high quality assets, meaning good locations, good fundamentals in the market, meaning increase of population, multiple employers in multiple industries, you're going to be in a good position to withstand any recession. Next one is diversification. By definition, in a fund, you have more than one asset, and from that standpoint, as soon as you have more than one asset, you're going to be in a diversified situation. Next benefit, for real estate fund is the forced appreciation. By improving operations and making renovations, you're going to be able to increase the net operating income, therefore increasing the value of the assets. Next topic is leverage. All these assets are being purchased with some leverage. Usually you'll have to put between 10 and 30-40% of the value as a down payment, and therefore you're going to be able to control between 2.5 to 5 or even 10 times the amount of value with your down payment. So that's leverage. Next, we have the dedicated professional management, and from that standpoint, what's interesting, if you consider investing yourself in real estate, you would be considered to be an active investor, and therefore, you have to rely on yourself to manage and make your decisions and take care of the day-to-day decisions. Whereas that when you go into a fund situation, now you're going to rely and leverage the experience of the fund manager. Then we have tax benefits, and from that standpoint, usually in a fund you'll be in a situation that your money is staying there for more than a year. Therefore, you will your investment will be considered to be long-term capital gains, so treated with a little less tax burden, but also in some cases you may benefit of other advantages such as depreciation. And finally, when you are investing in a fund, you have access to larger deals because now you have several investors pulling their money together, and from that standpoint, you can buy a larger asset.
So different options in the real estate realm. A lot of people are familiar with REITs, real estate investments trusts, and real estate funds. Syndications are not as common, and as well as a CPREF, which is a new type of fund. It stands for a customizable private real estate fund. We're going to dive in deeper to all these options. So starting with the real estate investment trust, as public and private. You can find public in the stock exchange. You can buy them as stock. You buy these shares and they earn income from the shares that you own in the REITs. They can be, like I stated, traded as stock for publicly traded REITs. For privately traded REITs, the way it usually works out is you hold those REITs till they either IPO or they sell all the properties and you get your capital back Sometimes you can find a way out if you don't no longer want to stay in there REIT by there's different companies that will offer you a fraction of the cost or the value of that REIT. So there's different ways to get out of it, but the publicly traded REITs are the quickest way to get in and out of REIT versus a privately traded REIT. These REITs can be either equity or mortgage based. They can operate real estate. They can own and operate real estate portfolios, or they can finance real estate portfolios or acquisitions. And 90% of these, the income is distributed as dividend per requirement, government requirement, mandated requirement. The tax benefits are somewhat minimal. It's very interesting. There's a lot of different nuances in regards to REITs, but the depreciation that you would see in a syndication, which we'll go later on, more in depth, is depreciation is considered in the dividend, so the payout. And then the typical returns for a public and private REIT are they're stated 5 to 6 to 7 to 8 respectively. Next slide. So here's just a pictograph of what a REIT's process is. You have your happy investors who invest their capital into a REIT. The REIT turns around and buys these different type of real estate, whether it's malls, office, hotels, apartments, whatever it may be. It could be a single type of REIT where it just focuses on grocery stores, or it could be a REIT that different type of commercial real estate. Then essentially they focus on generating growth through operation, maximizing income, lowering expenses. They get their profits through the rents collected and the appreciation, and the dividends are paid back to the investors. Considerations for a REIT. So most of these distributions are taxed as ordinary income. Unlike REITs that are like in the stock market, REITs in real estate, well, obviously are real estate related, but they are taxed as ordinary income. The corporate taxes is what I was referring to, the stock market aspect. So most corporate companies, most corporations get double, right? In a REIT, there is no double taxation. So the only instance that there's taxes on that income is through the pass-through through the investor, based on their ordinary income tax, based on their tax bracket. They are typically high in management fees. This is based off the SEC website, investor.gov. And they're, like I said, they're easier to get in and out for publicly traded REITs, a lot more difficult for private REITs. And there is a lower minimum to get into publicly traded REITs. It could be anywhere between $10,000 to $15,000 to get into one of those. And there is a subject to the same conditions that can cause stock prices to gain and lose value. And that's based off Zacks investment research. So now a syndication, which is less common. So high level, same thing, investors pool their resources to acquire a specific property, or it can be a small portfolio of assets. So overview of this is normally syndications are deal by deal. They have a general partners who underwrite, pretty much come up with a deal and put the package together, do all the legwork, do all the legal documentations with the lawyers, and then they present it to limited partners who own equity into the deal. They present it with all the returns, all the pros and cons, and it's up to the LP to decide whether to invest or not invest into the deal. SEC oversight, Securities and Exchange Commission. There's PPMs, private placement memorandums, which are documentations required for a syndication, and subscription agreements. Syndications, you get an investor portal where you could track all your investments in that specific deal, and it also comes with a K1 tax documentation on an annual basis. And usually the targeted typical returns for a syndication can be to 15 to 17% market, depending on some nuances. Things have changed a little bit with the increase in interest rates. Those are normally the target returns for IRR. So considerations for a syndication are that as a limited partner, you invest passively into that specific deal that you reviewed. That's your investment. You perform due diligence on that specific deal. You go through the entire process of vetting the sponsor, analyzing the deal and the market. You review the business plan, the underwriting, and any and all details you need in order to perform diligence and make sure it fits your investment criteria. There is a lack of diversification. The reason being is that you're invested in that specific deal. So, like I said, syndication is focused on a specific deal. So you are locked into that specific deal, specific market, specific real estate asset. So the diversification on that specific investment is not there. Usually the minimum investment is $50,000, and usually it's a 3 to 5 year hold. So for a real estate fund, it's pretty much like a partnership. Your capital is pooled with other investors. You are the overview is you're committed to invest in that fund's criteria. So the criteria can be that they are focused on, a breakdown of multifamily, self-storage, and grocery stores, or specific type of based on the fund itself. So diversification through multiple assets, you do not get to pick the assets you invest in, you're just investing in the fund. So there is definitely some diversification put into the fund for protection. So that's a good thing. The benefits are you get pass-through depreciation. And when you're investing in a fund, it's also a one-stop shop because you have multiple assets that you are invested in, but could be one PPM and subscription agreement that you have to just review as long as along with your investor portal and your tax documents. And the target returns are similar to a syndication. So there's a lot of similarities to a syndication with the real estate fund, except there's more diversification within the fund because of the multiple assets allocated or acquired. So here is a little picture on the way a real estate fund would work. So the investors purchase share into the real estate fund. The pool of capital is created. An asset is an income generating property is acquired, the real estate, and then investors start getting capital back, cash flow in the form of distributions from the cash flow generated, or as a capital event such as a refinance or a sale. So investors would get those returns however they may come, like I said, either cash flow or a capital distribution. Next slide. Okay, so the considerations for a real estate fund, the lack of criteria flexibility. So if a real estate fund has specific criteria to stick to, such as, here's an example, 50% office buildings, 25% apartment complexes, and 25% hospitality. In an effort to create diversification criteria, even if the market shifts. So during COVID, we saw that a lot of office buildings were vacated and people were sent home to pretty much telework. That would have took a really big hit on the fund itself. So considering what kind of criteria are locked in within the fund is something to consider. There is lack of control of deal selection. You do not the assets that you are invested in, as stated previously. Even if you do not like market, let's say they're investing in, I don't know, Chicago or whatever market you're not really keen on, that's part of the portfolio. So that's just, nature of investing through a fund. You do not pick where the deals are selected or what assets are acquired within the fund. The low transparency is pretty much in regards to deal performance, individual deal performance. So a lot of the returns are blended. And so if one asset is not performing as well as others, that's part of the whole thing of diversification. It helps the entire portfolio itself. However, you do not necessarily know which deals are performing optimal and which deals are performing poorly automatically. So because you're blended into your returns, you get pretty much the overall picture of how the fund itself is performing. There is administrative and management fees applied when investing into a fund, just like a mutual fund or something of that nature. And then the holding period of a fund can be 10 years. There is a research process, the acquisition process, they're generating, increasing the value of the entire portfolio, and then they have to turn around and sell. So there's a cycle of the entire process, and it could be 10 years. Now we want to talk about the customizable private real estate fund, the CPREF. So essentially, it's a fund with the flexibility of a syndication. So like I stated, the fund has a lot of diversification because of multiple assets within it. Syndication, you get to pick what assets you are going to invest in. So this CPREF allows you to diversify within the same fund, with also the ability to pick what assets you want to invest in. So you get to be involved in multiple assets within multiple markets. You can essentially create a portfolio of investments within the fund, and you get to experience tax benefits such as you would see in a syndication, such as accelerated depreciation and whatnot. Also, there's a one-stop shop, just like the fund and the syndication. You get PPM, subscription agreement, investor portal, and also K1 tax documents. The target returns are similar to a syndication and a fund. The biggest takeaway is that you have deal selection. It allows you to pretty much peek in to the fund and just pick what deals you want to invest in turn creating that real estate portfolio. So considerations, just like a syndication, minimum investment would be around $50,000 on average. Also a 3 to 5 year hold. And the thing is, you get continuous access to these vetted deals. So because you're part of the fund, you have signed PPM, you have signed subscription agreement. You get a peek in every time there's a new deal that's added to the fund. You get a peek inside and make the determination whether you want to invest in that specific deal and increase your portfolio or not. Diversification, control, and flexibility. That is all something that is provided to a investor who invests in a CPREF. And as stated, you get access to multiple real estate asset classes, such as Class A, B, or C, or property types. It could be a debt fund, it could be an apartment complex, it could be a self-storage. So you're not just tied to one type of property type. And then distributions are made to investors first within the CPREF. Next slide. So here's a comparison chart. This is not to say which investments are better or which are worse. It's just just to show which one would fit your investment criteria. It just identifies, what kind of tax benefits deal selection, just pretty much a comparative analysis. If you choose to do syndications, REITs, it all depends on the investor and the investor's goals. Next slide.
All right. So, one of the things to consider when looking at a fund, or different nuances of the different funds, is to understand for each particular individual deal, or let's say for the fund, as a whole, what's the business plan that is going to be applied, right? So the typical business plans are the core investment, core plus, value add, and opportunistic. And again, from that the standpoint of evaluating these different business plans, what's interesting is to understand what are the risks and the rewards of these different business plans. So first we have the core type of business plan, and this type of business plan is that we're going to buy high quality assets, and here the particular examples, they apply more particularly to multifamily. So it would be assets with high quality tenants, or in some cases, if you want to take a look at office space, for instance, it would be an extended lease term. But it would be also in desirable neighborhoods, large markets. As I mentioned, higher quality, newer construction, more recent than 10 years, experiencing low vacancy and a very stable occupancy. And usually on those type of business plan, you would apply pretty little leverage. And the idea there is to have a very dependable revenue, right? That you can withstand easily recessions or any change, in your occupancy, for instance, if there was really like a downturn. So most of the returns, they're going to come from the property's cash flow rather than appreciation, because really it's such high quality, there's not much room to improve the NOI, therefore the value of the asset. So the typical returns for the core type of business plan is between 6 and 9%, and the risk is really low. The next type of business plan is the core plus type of business plan, and plus leaning, there's a little more opportunity to improve the asset. Which, by the way, these pictures actually I'm using to illustrate is there are pictures of actual deals that we are running right now. Core plus, you still have high quality tenants. Properties also are in good neighborhood, but you're looking at slightly dated construction and finishes, though it would be in a maximum of 30 years old, and also pretty low to moderate vacancy rates at 5 to 10%, and you would use a little or moderate leverage, between 50-65%. It's a cash flowing asset still. You can, when you're going to purchase this asset, it's going to cash flow day one, but you have the ability by doing some renovations, for instance, increase the cash flow and therefore the value of the asset. Now what you have to bear in mind is you need to allocate some money for deferred maintenance, basically. So you need to make sure that you have some reserves available. So this type of business plan, you're looking at 9 to 12% returns, and the risk is considered medium to low. Next, we have the value add, and you'll get the gist here of we're going to more and more risky higher returns. But tenants in that particular case, they will pay below market rents. You still have, and that's going to be part of particularly our criteria for selection. You want to be in a decent to good location, but you have dated finishes, deferred maintenance. Usually, over 30 years ago from a vintage standpoint, construction date, and possibly higher vacancy rate. Not terrible, but in the 10%-ish. And you would purchase those with again higher leverage, 65 to 75%. In that particular scenario, you're going to start with very low or very little cash flow, especially in these days of high interest rates. And you're going to spend a lot of money on upgrading the property and then attract new tenants at market rates. So there is potential to generate high cash flow once the value is added, once the renovations are made, but it's going to take a couple of years. Typically, the returns for this type of business plan are 12 to 18%, and the risk is considered medium. So finally, we have the opportunistic. And what's interesting, as I show in my in the pictures here, both a ground-up construction as well as a very distressed property would be considered opportunistic, right? So, and again, but you have to think about it in the same terms, right? So, ground-up construction, you don't have any tenant basically, and you're building a property in an area that may be, it's a development area in that case, or it's a redevelopment, and then you have the opportunity to revitalize a neighborhood, for instance. So usually you have very high deferred maintenance, boarded up units, or basically no units at all, because you have to build ground up. Very high vacancy rate, above 20%. And also the leverage used there is going to be above 75%, and typically using bridge debt, meaning variable interest rate and so on. So, as you may understand, like, these days, variable interest rates are going to be very high because of the Fed interest rates. So it becomes a more risky investment business plan, right? So higher risk, higher returns, 18% plus in returns, but basically no cash flow when acquired, and the appreciation really meaning that your ability to increase the net operating income, the cash flow, that's going to be the key to increase the value of the property, and that's how you will make your returns. So high cash flow after the value is added, as I just mentioned. So if you look at it you compare the 4 different business plans on a risk return chart. You have core, low risk, low return, core plus, a little bit more risky, higher returns, value add, again, more risk, more return, and opportunistic, more risk, more return. But as circled in red here, our bread and butter is going to be mostly in value add, and I see I miss an L, and core plus business plan. So that's all we had to present to you. So in conclusion, funds, they give you many different options to invest in diversified, professionally managed, larger deals and build your your passive income. Though as usual, and I know we want to talk about risk and reward at every of our presentations, but it's very important to understand the different risks and rewards. And we just mentioned to you today the 4 type of business plans. And as usual, we encourage you to do your own research and consult professionals, before you embark on your own real estate investment journey. A little quote we wanted to share today: the best preparation for tomorrow is doing your best today. And since we mentioned that during the webinar today, we have our own CPREF. If you want to get to know more about this our fund, our CPREF fund, you can go at www.boostmycapital.com/CPREF, as you can see at the top right here of the screen. And you can read a little more information about our CPREF fund, and you can book a call if you wanted to know more.
The question from Beth asking, why not just buy a house instead of investing in an apartment, I guess, apartment community. You want to take that? Or
well, buying a house, I guess, is buying a house as an investment.
I would assume so, yeah.
So rental property. Well, so yeah, it's interesting. I've been there, done that myself, and Jeff, I believe too. The number one is, I think is in order to have enough diversification, you have to reach a good number of individual units or doors or houses. So until you reach, for instance, like 5 to 10 houses, you're going, your investment is going to be very much tied up to, do you have a tenant or not? And then your occupancy is either 100% or 0. So are they going to renew the lease? You have to do some turn the unit that could cost thousands of dollars. I've had unit turns and tenants who vacated the unit, and basically that wiped out all my returns for the years. Or 1 year I had to replace a roof, for instance, that was inspected and seemed to be fine initially. So I think and if you're fine with that, I think there could be higher returns potentially, but more headaches, more hands-on work, and it's until you reach a good number of units, you may experience like tremendous variation in your cash flow.
Yeah, so not all types of investments are for everyone. Whether you have the time to be an active investor and buy a house, manage it, fix it, and take tenant calls, then that's one thing. If you are extremely busy with your profession, with your family, with just living your life, but you want to maximize your income and find different streams of income, doing a passive investment opportunity may be a good fit for what you're trying to create. But all investors are different. Every criteria is different. It's always good to just kind of, get on a call and what's available for you, shop around, and just kind of figure out what's out there for you. Being part of a apartment community, being owner of an apartment community to a syndication or a fund is achievable. It's something that you can do. It's not something that's out of your reach. So that's why we want to have this webinar, to kind of let you know that you can too be part of a owner of an apartment community and receive passive income, still focus on your 9 to 5, and working on the growth of your financial situation. So if you want to schedule a call, feel free to reach out to us, investorrelations@boostmycapital.com. You can scan the QR code, and I believe it'll take you to a scheduling calendar. And yeah, we'd like to connect with you. If you have any questions, you can email us or give us a call. And we, welcome any all questions, and we'd like to
So
get to know you better.
we have a couple of questions in the Q&A, Jeff. Mr. Seti or Miss Seti is saying, asking, in the Core Plus, there was needs an allocation to pay for future deferred maintenance. Yeah, so I think the idea with the Core Plus is you start to have a little bit older property, and the risk there is to underestimate. If you are the end of useful life of the roof, for instance, you need to take into account in your budget a roof replacement. And actually, we looked at exactly that earlier this year. We're looking at 82 units from the late 80s, and that's exactly what happened. Is the even though, like, I think the basic business plan, or we are going to make some renovations, looked a little bit dated. We could increase the rents, but at the end of the day, when from the ground the roofs looked fine, but then we sent an inspector on the roofs, and they said, well, you should really budget for roof replacements because they're not in that great of a shape. So and it didn't have to happen like just at acquisition. It was going to be during the next 5 years or hold period that we would have to have money on the side to replace the roofs. So that's what we mean by an allocation to pay for future deferred maintenance. So the more you're going from core to core plus to value add, the more money you're going to need for capital expenses to do your improvements, as well as the higher your reserves should be. That's the idea. Next question from Craig. If I have a syndication deal, would like to partner with Boost. Well, I guess what would be the next steps? Well, I guess we should get on a call and talk about it. So yeah, email us at investorrelations@boostmycapital.com, and Jeff and I will get back to you, and we'll set up a call. From Alex, can we sell our share of CPREF before the end of the holding period? Would you help sell? So can you sell it? Is it possible? I would say yes. It's like any type of shares that you own in a company. It's possible. Now you have to understand it's not very liquid. And of course, if you're invested, and this was going to come up, and you want to sell your shares, we would assist in finding a buyer, or probably consider buying ourselves. But however, there's no guarantee it can be done, and there's not necessarily after, yeah, there might be an impact on the price at that point.
Yeah, understanding that these investments are long-term, 3 to 5 years is imperative for an investor before they get involved. That's why it's not very common to sell these type of shares like it is for a REIT, for example, that's publicly traded. It affects the returns if an investor comes in at a later date, say 2 years, and the returns were 15% IRR. That new investors return are not going to meet that original target IRR. So there's a lot of nuances there. If, for example, if someone owns shares and they had a buyer, we would definitely work that out. But it's not highly recommended. Just know that if you're going to invest in a passive investment opportunity like this, that it's for a 3 to 5 year hold, and that it should meet your investment criteria.
But though we do have right now, one of our opportunities is a short-term debt, which it's a little bit unique because the business model behind the short-term debt is to lend money short-term on basically fix and flips or ground-up development of single family. And on that particular investment, the minimum hold is 1 year.
So that's an opportunity for someone to get involved if they're still kind of confused on how the process is. That's a kind of get your feet wet type of approach before you commit to a 3 to 5 year hold on a larger scale acquisition. But it allows you to invest passively into into a debt fund pretty much, and which is specifically for fix and flips.
So another question is to invest, do you need to be accredited or non-accredited investor? In our particular fund, you would have to be an accredited investor. Meaning, I mean, we can spend a minute on that. If you're single, it's $200,000 of income over the past 2 years with reasonable expectation to maintain that income current year, 300,000 if married, and otherwise $1 million in net worth, excluding the primary residence. Or there's a third option currently that is tied to having investment licenses, or basically like a registered advisor licenses. And interestingly enough, they might be, or I believe, I don't know if the law was passed yet, but there are discussions to be able to take a test to become an accredited investor that will become a future option down the road.
Yeah, that could be about a year out, possibly. FINRA is supposed to be on the hook to provide that type of testing. But like Philippe said, it's probably a year out. It's been passed, so an investor that's not accredited, based on his understanding of investments, will be able to invest in accredited investor opportunities because of their understanding of these type of investments. So that's a good thing for folks that want to get involved in asset classes and investments that they wouldn't otherwise be able to participate in. But we'll keep you guys posted.
Yeah. Right, like, don't hesitate if you have another question. Otherwise, we will end the webinar here. You know, we wanted to thank you, to say thank you to all of you who attended. Hopefully you learned something. And, you know, regarding the different options available, risk and rewards, you know, again, very important to us, as well as diversification. You know, stay tuned. There will be a replay sent out in a few days by our team. And, you know, otherwise you can expect another webinar next month. So we will see you soon. Thank you and bye-bye.